secured ways through Cuddle that you can increase your non-prime auto loans without adding any risk to your portfolio. For the people that are on the phone, if you don't have access to the Zoom, just let me know and I will send you Steve's presentation. And I have, I'm gonna chat. Go ahead. Thank you, Steve.
Hi, good morning, Christine.
Good morning.
Can you hear me?
Yes, I can.
Excellent. So I'm going to share my screen. I just want to make sure that you guys can see everything.
Yes, we can.
Perfect. So again, good morning. My name is Steve Sureda, and I am with Open Lending. We work with credit unions, really auto lenders around the country for the last 20 years or so. So I thought today, as part of this indirect lending roundtable, I could tell you a little bit about who we are, what we do, and more importantly, how we can help you guys manage your auto lending portfolios. I like to use this illustration as an example of really where Open Lending fits, or where our program Lenders Protection fits. If you think about indirect lending, there's certainly a lot of challenges as compared to direct lending, right? We all love direct lending. Indirect has additional costs in terms of your dealer comp. There's additional cost in terms of performance, default risk. Default risk through the indirect channel is literally twice what it is through the direct channel. You lose control of the point of sale, right? So many of your borrowers become members of the credit union. Many times they don't even know anything about the credit union, and they become that dreaded indirect commodity product, basically. So our program, and I should say on top of that, with the additional costs, many of the credit union lenders we work with are really prime focused, right? You're trying to, for obvious reasons, you're trying to avoid that default risk, charge-off ratios, delinquency, et cetera. So at the end of the day, you're going out with in a rate-sensitive environment, trying to compete with a whole bunch of other lenders out there looking to do the same thing. At the end of the day, your margins are very skinny. With our program, we focus more on what we call this underserved population, this near-prime, non-prime consumer. The average score in our portfolio is around 630 through the indirect channel. 560 to 660, 680 really is what I would consider our sweet spot. This is a population that really is preyed upon by some of your finance companies, some of your high interest rate, buy here, pay here type lenders. So it's a great opportunity to take advantage of what we see typically is application flow that's already coming through your credit union. But you're either declining it outright just based upon the credit characteristics, or maybe you're approving it, but truncating the terms of the approval, and that loan ultimately gets shopped somewhere else. So we have a program that really has a nice niche, fits within this space. We have a program guidelines that are geared around this near-prime, non-prime type of borrower. And we have all kinds of tools and technology to help you not only capture this business, but not only approve more of this stuff, but fund more of these loans as well, further ingratiate yourself with your dealer partners. Really a win-win for the lender, for the dealers, and for your members as well. With that, I thought we could take a quick look at a snapshot of the Vermont auto lending marketplace, right? So we subscribe to a service called Auto Count, which really provides some great auto lending data every month. This is an eight-month snapshot up to August 2020 of this year to date. And it just gives you an idea of the lender competition you have out there, the type of credit risk they're taking on, what their market share looks like, and what are the typical interest rates that we see across different risk tiers. Risk tiers ranging from your subprime stuff below 560, what we call a lender's protection wheelhouse in that 560 to 680 range, and then really your prime tiers north of 680, 700 plus. One thing I noticed about Vermont, very strong credit union influence. In your top 15 lenders, which represent really almost 80% of your overall market share, you see a whole bunch of credit unions in here doing really well. One thing I'll point out is, again, look at your average credit score. This is just used vehicles as well, by the way. So you're going to see that average score compressed somewhat. On the new side, you're going to see that average credit score north of 700 plus. But what you also see in your top 15, 20 lenders are this credit acceptance course of the world, charging exorbitant interest rates, in this case over 19%. You'll see the same with Cap One Finance, not quite as high on the interest rate side, but definitely digging down into the low end of the pool. Your Santander's average score, 576. You see your interest rates north of 18% as well. So this is an opportunity for all credit unions, with our programs specifically, to really capture a lot more of this non-prime business in a way that makes sense for your credit union, and makes sense for your members, and more importantly, it's built for the long haul. Again, Lenders Protection specifically, what we do is we provide a set of expanded underwriting guidelines, right? Expanded offer. So if you think about your non-prime borrower, what's important to that borrower is really what they don't have basically is cash flow much of the time. So payment amount, down payment requirements are very important to those borrowers. What we see typically is a lender will truncate that approval, forcing the borrower to put down more money. And a lot of times, again, that's going to go somewhere else, a lot of times to those high-rate lenders that we see on the auto count report. So we're able to provide that expanded approval. We're able to build in a strong rate of return. We see net yields in our program typically 4, 5, even 6 times what you're going to see in a prime portfolio. However, ostensibly, you're taking on more risk. Again, our average credit score is around a 630. However, with our program, we have a default insurance product that's built into the back end. So what you're doing as a lender is you're capturing that higher, ostensibly higher risk business, but you're transferring that default risk away from the credit union. So at the end of the day, what you're getting is an A-level asset that's earning, again, 5, 6 times what you'll see on a prime portfolio. The cost of the program, the insurance cost, our Lenders Protection cost, all built into the interest rate. So it's truly a pay-as-you-go type of program for the lender. It's something that's unique where you can private label. We see it as a best practice. Most of our lenders will private label the program, the Go Loans program, the Green Light program, something along those lines. Something that distinguishes it from what you're doing today, and it's something we can help market it to your dealers, help your dealers understand exactly what you're looking for, and really, from a dealer standpoint, now you become what we call a full spectrum lender, right? So as you're buying more, simply put, as you buy more 630 scores, 640 scores, you're going to capture more 740 scores as a result. Our data suggests it could be as much as 20, 25% lift in your overall lending application flow. Think of this program, again, as just another tool in your toolbox as a lender. You control how you use the program, where you use it, in terms of channels, credit score ranges. You determine how you use the program. We're just providing another tool. If you're not seeing value in the program, there's nothing binding about this agreement or this program. You just stop using it, or then we part ways. It's designed really to be mutually beneficial. If you're having success, we're having success. And you can see some of our credit union partners below. These are some of the larger ones: PenFed, ViStar, Randolph Brooks. But we've got really somewhere on the order of 500 lenders, predominantly credit unions that we work with throughout the country, really all shapes and sizes. This is a scalable program. It fits all different types of credit unions.
Now, Steve, when
yeah.
I used to go out on the road, I know a lot of the dealerships would say, well, I'm not going to give you the loan because I have, or I'm not going to give you the best credit because I have another credit union that's always, buying a little lower for us, helping us out. And so this is where this program would really help with their balance of portfolio.
Absolutely. That's exactly right. Great tool to again, ingratiate yourselves further with your dealers, not only in terms of what you're buying, but as we get into our more specifically with our underwriting guidelines, we also offer a back-end allowance so your dealers can sell their gap and warranty products. Has no impact on the interest rate. In addition to that, in terms of dealers, speed and consistency is what dealers really look for, and at least in our conversations with dealers over the years. What they value even more than compensation is that relationship with your lender partner, and the speed and consistency of that approval. If you're the first one back with a quality approval, your odds of getting that deal go up significantly. And you're going to see with our automation through CU Direct, it really becomes a one-click interface where you click a button that says submit to lender's protection, you click a button, that whole process becomes automated. We got an answer back to that dealer in a couple of seconds, 5 seconds typically. So very powerful in terms of managing your dealers and getting that response back as quickly as possible.
So there's no,
I'd like to look.
So Steve, there's no integration with any of the Cuddle program. It would just be automatically added in there, and then you just push a button, and then if they can't approve the loan, then they would just click this lender's protection button, and then it would take them to another area, which would automatically either approve or say no.
Yep, we have that interface built into L360 today. Are you guys using L360 through the QSO?
Yes, and some people have it integrated with their LOS system.
Sure. And we have interfaces not only with just L360, but with most of the LOS providers around the country. So, Meridian Lake, TCI, I see a lot in the Northeast. So we've got all different levels of automation with a whole host of LOS providers. So there's no cost to the lender. It's already built and paid for. It's just something we can enable. Typically, it's a flip of the switch, and our interface will appear in your loan origination system. It can be as simple as click a button, and that underwriting process is all automated. You get a response back. Or you can code rules. Say within a certain score band, we want to automatically submit this to lender's protection. So this way, the lender is just working an approval queue. And then finally, with what I call the Cadillac of automation, you can automate that response all the way back to the dealer. So it hits your, what we call a trigger. How do you want to use the program? A typical trigger that we see, or best practice, is an application between 560 and 639. Submit for insurability. Typically your highest risk segment. 640 and above, if you're declining it or if you're conditioning the approval, you may submit that stuff as well. That's typically what we would see as a trigger. So if you're automating back to the dealer, say it hits that score range, 560 to 639, it automatically routes it for a decision, pushes that response, that approval or that decision right back to the dealer. So the lender is even hands off on that whole process. So you control all those three different levels of automation. So if you're uncomfortable with pushing it all the way back to the dealer, you can just route it for approval, or what we call manual is you click a button. So the lender initiates it by clicking the button. So I like to look at this matrix just as an illustration as to just to reinforce where our program would fit. So credit score on your left axis, LTV is very sensitive in our approval. Along your top axis, we can provide a trade LTV, retail LTV. We can accommodate either method. So what you see in your higher credit scores, what you're seeing in the gray shaded cells, this is kind of where lenders are living today. You're going to continue to do these loans just like you would today. Where we come in is, in your upper tiers, is it a thin credit file perhaps? Is the advance too heavy? Maybe you're submitting that stuff. As you get down in your lower credit tiers, this is typically where we're going to fit. We're going to be able to provide an expanded approval in your lower tiers, terms out to 72 months, 78 or 72 on the indirect channel. So we try and get those borrowers into an affordable payment amount with the least amount of cash out of pocket, or if any out of pocket for the borrower. And we can generate approvals. Our typical approval rate for us, average credit score 630 in this program. We're seeing somewhere between a 65-70% approval rate very consistently. As we go up credit tiers, you're going to see those approval rates increase as well. What I typically see is approval rates 560 to 639 credit score range, maybe 20% a lot of the times, 30%. So immediately we're going to provide significant lift in terms of what you're approving, and then again, the capabilities of the program are going to help you capture more of that business. We're typically about 10, 15, on the high side, 20% of the lender's overall lending activity. So it's not a replacement to your auto lending, it's just an extension of your auto lending program. Our buy box, you can see, is very competitive. In terms of max advance, $50,000 max advance will go out to 145 LTV front end. So that does not include gap or back warranty products, where we provide that 20% back end allowance. 145 is a trade LTV. So for a 630 credit score, LTV is probably going to be about 115% front end retail. So a lot of times we can get that borrower with no money down or very minimal money down. We have some disaster checks, obviously. If you're bankrupt, if it's discharged, great, we can work with you. If it's been dismissed, has to be dismissed for 2 years or more. You know, if you have a current delinquency on your mortgage or auto loan, that's going to disqualify you as well for obvious reasons. We got some DTI, PTI caps, and you know, we'll go back as far as 9 model years. Mileage maxes at 150, but really up to 7 model years to 100,000 miles, we can do a 72-month term and give you the most robust approval. After 100,000 miles, we start to truncate the term. So the benefit of this back
Steve,
up this Bible.
Steve,
Yeah.
We just have a question here. How does this work with members that get lobby rates?
Members that get lobby rates. So you obviously got to manage your channels, right? Your indirect versus direct channels. We're going to determine or build out pricing for this portfolio, your lender's protection portfolio. I'm going to jump in here a second and illustrate that for you. But we have a risk-based pricing model where we're going to customize all of your costs, what you want to earn on a net basis. Basically, we want to account for every dollar going out the door to originate and service your insured loan. Ultimately, those costs are going, and the risk in the application, the credit risk, when we underwrite it, basically we're providing a risk margin, which is really what we're insuring. So we're going to solve for each interest rate. Our rates are never going to be the same as your lobby rates, right? Because this is a higher risk portfolio. We have higher advances. So the risk margin is going to vary on a loan-by-loan basis. So that's probably a little muddy at this point as we go through the presentation, but hopefully it'll become more clear as I take you through the pricing and underwriting piece of this. Everything in this buy box, by the way, we know we can insure. That's really how we get to the limits of this buy box. It's what's within our insurable limits. And really what makes this engine run, this program run, is our proprietary underwriting engine. This is really what you're paying for with lender protection. We've got data going back almost 20 years of non-prime auto lending, and we leverage that data to empirically derive our underwriting rules, making sure that, hey, this is something we can insure. And this is an analytical company, analytical infrastructure. It really data drives everything we're doing. And then we automate that whole process. I've mentioned the LOS interfaces. Our engine is plugged into those. So this whole underwriting process becomes automated. You got a response back in a few seconds. If you think about how a lender would, a loan officer or a buyer would underwrite a lower credit score today, they're going to be scrutinizing that application just based upon the risk. That just slows down the process, right? So with our program, it's all automated. You get speed and consistency in that response. That's going to be key to identifying the risk, pricing for the risk, and then again, providing a great product for your dealers.
And Steve, does all of the stipulations come over automatically as well to the Cuddle
Yep.
loan?
Yeah, they sure do. They'll be displayed conspicuously in our approval. Right there, it'll show up right in your LOS. And really, our stipulations are pretty basic. We have a couple. We need a third-party validation of the collateral. Like most lenders will have a bookout sheet that they're using that suffices. So already part of your loan package. And then we do require proof of income below 680 through the indirect channel. Most forms of POI are going to work. So that may be something that's a little different from what you're doing today as a lender, but those are really the only two stipulations, and they will be displayed right in the approval. Our risk-based pricing model I had mentioned, this is something we're going to customize very specifically with you as a lender, right? So what are your funding costs? What are your servicing costs across risk tier? What do you want to earn on a net basis? What are you paying your dealers? What are you paying the vendor to go repossess and sell a defaulted auto loan? We account for all of those to ultimately get to a true risk-based price. And that all includes the insurance component or the cost of the insurance. We've got a couple A-rated carriers that we work with. AmTrust Financial is one, and CNA is another. We randomly assign each application to the two different agencies just to spread that risk around. And we've got great due diligence on both of those carriers, along with us and all of our partners as well, should we get to that point. And again, I mentioned that every loan that is approved through the program, it has its own insurance policy on the back end, right? So there's a lot of benefits to having an insured loan portfolio. The largest, most glaring of which is that risk transfer component. So you're taking that charge-off risk and you're transferring it away from the credit union in the form of a claim benefit payment. We typically cover 85% or more of your aggregate deficiency balances. That's a direct bottom line result on your charge-off ratios, your provision expense, and just as importantly, how you fund your reserve. Most lenders these days will fund their portfolio, their reserve at 15% of face value because we have that claim as a backstop. Once we pay our claim, just some notes about the policy. Once we pay our claim, we're out. There's no subrogation. You own, as a lender, you own the debt. You're the insured, not the borrower, so it's transparent to any dealers you may work with, any borrowers. You don't want them to know there's insurance on the loan. So if we pay a claim, say the borrower owes you $8,000, we pay a claim of $8,000. We want you to report to the credit bureau that borrower still owes you $8,000. Take our claim payment as a recovery in that period, so you're getting the benefit of that reduced charge-off. But report that $8,000 to the bureau, and then you can collect that on a post-charge-off basis. And that's granted, that's a tough collect. It works in some states better than others, but it's an asset still that you still have, so you can basically double dip. There's each loan has its own insurance policy, so you'll never run into a stop-loss ratio. There's no limit on the number of claims you can file. You'll never be re-rated as a lender. First payment defaults, we don't expect them. If they happen, you file a claim like anything else, any other claim. So again, each loan is insured on its own right. And so let me give you an example of how the claim works and what the shared risk aspect of the program is. So think of our policy as gap insurance for repossessions, right? So really what we're insuring is the depreciation risk in the vehicle. So I'm going to give you a couple of examples to show you how our claim gets paid. So say we have a car, it's at, goes into default, you get your collection queues, you guys work it. Hey, this is default, we accelerate the loan, you go repossess the car. The balance on the defaulted balance is $20,000. You repossess the car, it's worth $10,000. In our program, very specifically, NADA clean trade value is how we run the program. You can still run your collection process, your auction process exactly how you do today. It's independent of this claim process. So $20,000 balance, the car is valued at 10 in green, 9,000. So you sold it for $9,000 or 90% of that car's value, not the balance, but the value. That's within our coverage limits because we can pay down to 80% of that value. So you sold it for more, in this case it's $8,000. You sold it for more than that. So 20 minus the 9, you have an $11,000 deficit balance that's going to charge off. We're going to pay a claim of $11,000 plus 60 days worth of interest. You're made whole in that scenario. Scenario 2, same balance, same value. Car's more damaged, you sell it for $7,000. So that's 70% of the value, which is just 10 points outside of our coverage limit, which is down to 80% of the value. So in this case, you have a $20,000 balance, you sell it for $7,000, $13,000 deficiency balance. We're going to pay a claim of $12,000, the 20 down to the edge of our coverage limit. You're left with $1,000 of uninsured loss. Truth be told, this happens all the time. We expect it to happen. We trend nationally right around 80%. So it's a very achievable figure. Go ahead.
I was going to ask you that. Is it always 80% for, like, you will buy back 80% of the loan to value?
No, we're going to pay off the loan.
Right.
Pretty much. Right? So 80% is the edge of our coverage limit. So that's the shared risk aspect of the program. If you sell it for less than that 80%, so look, the car comes back with a transmission in the trunk and it's worth $1,000. Your uninsured loss will be larger in that case, but by and large, as you put volume through the program, we typically see lenders achieve right around 80% on the sale of that collateral relative to the sale. They get 80% of that value. So it's a very achievable figure, and more importantly, it's something we price for and track and manage very specifically. So in this case, when we build out your pricing model, we're going to account for this expected uninsured loss such that it's a zero-sum loss equation for you as a lender every time. Either you're fully made whole through the claim benefit payment, or any residual is picked up through interest income that we're building specifically into our pricing pool. So let me stop there, Christy. Is that clear as mud? Any questions on the claim process?
Does anybody have any questions?
It's obviously something we can circle back on.
Yep.
Okay.
And now, do you pay, I just have a question. So if this scenario happens, you're going to be paying them on scenario number 2, the $12,000. And how quickly do they receive their funds? And do they submit the claim?
Yeah, we pay claims out twice a month. So we're the last step in your collections process, right? So you sell the car, you're left with that deficiency balance. You're going to file a claim with us. You'll be paid typically within 2 weeks, 2 to 4 weeks max. So we pay claims out twice a month. If you file it at the beginning of the month, you'll be paid mid-month. On the back half of the month, you'll get it on the first of the month.
Nice.
So you're not sitting around waiting for your money.
Right.
So, okay, so this is a snapshot of what our pricing tool would look like. We have modules that fit indirect, direct, recapture, refi. Specifically for indirect, again, we would, 9 different credit tiers. We're going to customize your cost of funds. And this is a flexible, dynamic tool where your cost of funds goes up, you expect it to go up or down. Hey, it's just an email to our team. We're adjusting cost of funds from X to Y effective this date. We make the update that day, you roll with the new rate the next day. So you're always out in front of those trends. Servicing expense, as you go down your credit tiers, there's more calls to make, more letters to send in theory. So your servicing expense is going to increase. Many credit unions don't have this kind of detail. So this is certainly something we can assist with. We've teased out some basic default settings that we will use. We looked at some studies from Filings Institute, and Callahan and Associates was another one, where they were looking at the pricing for packaging up auto loans into securities, basically. And the servicing ratios they were using were right around 40, 50 basis points. The average credit score was north of 700, probably more like 720, 730. So you can see we have some default values here starting at 80. These are very conservative, but again, customizable at the lender level. These have a direct one-for-one impact on the ultimate interest rate. Your funding costs, your servicing costs, and then what do you want to earn? Net ROA. I mentioned on your prime tiers, prime portfolio, you're going out with a low rate to compete. Your expenses are what they are, and a lot of times you're landing on a net ROA, typically a very skinny margin. We're going to build in upfront, what do you want to earn on a net basis? And as you get down to your lower tiers, where we live, you can build in a little more ROA. Rate is not the be-all, end-all, in your near prime sector like it is in prime. We can, if we're in the neighborhood on rate, if we're a couple hundred basis points heavy than what you see in the market average from auto accounts, for example, we're typically coming back with an expanded loan offer. And with the speed and the consistency of our automation, a lot of times a couple hundred basis points is not going to matter at all. You can build in some additional margin and still be very competitive in that space. So these three components get us to a target yield. And this is basically how we get to our interest rate. Once we understand your inputs, then we're going to solve for an internal rate of return that's equal to this target yield that we've customized with you. So we're always coming back to the lowest possible rate that covers your costs and hits your return targets. We adjust it for collateral sales. This estimated sales, I'm assuming you're selling every piece of repossessed collateral for 70% of that clean trade value that we looked at. So I'm building in some incremental interest income. You're paying a vendor to repo and sell the car. We want to understand that cost as well. If you have any origination fees or your dealer comp, I'm assuming a 2% dealer flat in this model. Again, we want to account for every dollar going out the door to originate and service your insured loan portfolio. Again, totally customizable at the lender level. This is an example of how it would look in terms of interest rate breakdown. And you see starting from the bottom up, this is looking at a 640 credit score, 100 basis points in funding, 110 servicing, 260 ROA target. And you can see these components gets us to that 470 target yield. But we got to charge an 11.2 interest rate to achieve this 4.7 target yield. And these are all the components that are driving that. Uninsured loss, repo costs, dealer flat, and then the program costs. One is our program fee, and the other is the insurance cost, basically covering charge-offs. And this 3.19 in this example, this is going to vary very specific to the risk profile on the loan, and that's the power of our underwriting engine. We have over 2 million individual pricing cells that an application can land in. And
So,
just to
Steve,
illustrate the power of that. Yeah.
I have a question. So if I have an interest rate, I think that was 11.20, right? On the last, 11.20. And then my credit improved a lot. And I came to the credit union and asked if you could reprice my loan. And then are they allowed to reprice with this program if I made it to the 2.99 tier or whatever? How would that all work?
So And that really what you're doing is rewriting the loan. So once you rewrite the loan, you're canceling the coverage.
Okay.
So if you rewrite the loan, you have to rewrite it as an insured loan. Many times, I would steer away from that with this program, frankly. Borrowers are going to pay off. Like, we expect borrowers to pay off. We model that stuff. Prepayment frequencies are probably about, the first 3 years, we probably see about 60% prepayment rate. So that's pretty typical. If their credit score increases or their profile improves and they reapply or they want to refi or get a new car, you can certainly re-underwrite them. They might not, through our program, they might not need it if it improved. Maybe you don't need to insure it the next time around. That's also a benefit of the program. You're putting borrowers in a loan that really gives them a chance to succeed, as opposed to the Santanders or the CACs of the world that are charged up 22%. Those are interest rate traps that they're never getting out of, right?
Right.
So I would steer away from rewriting. Just, understand once you close out that loan or pay off that loan, it's no longer insured. So just things to consider on that front for sure.
Now, are they allowed to skip a payment?
Yes, we have 2 skip-a-payments built into the policy, 2 per year. Most of the time we see skip-a-pays will be member in good standing, holiday skip-a-pay. Your credit union typically charges a fee for the skip-a-pay. Things like that, we recommend you could, where we allow it, we recommend you continue doing it. It's a great member service. Our analysis in the past tells us that the fee that you're collecting is more than offsetting any exposure on the back end should that loan end up in a defaulted status. Because really what your exposure is in that case, should that end up in a default and come claim time, based upon the age of the loan, there's a certain payment frequency or expectation that we're looking at for paying our claim. So if you skip that one payment, that's going to be missing. It's basically going to be backed out of our claim calculation at the end. So you're exposed for that payment, right? So from a member in good standing, have at it, continue to do it as you would today. I wouldn't do it from a collection standpoint though, right? If the loan, a lot of times you see lenders will do workouts or loan modifications, right, as a collections tool. With our program, once the loan's in collections, you need the insurance even more so now, right? So when it comes to working from a collection standpoint, I would stay away from any type of loan mods or restructures or deferments in that status. Does that make sense?
Yes, thank you.
Yeah. I wanted to come back to the insurance cost, right? So that's the biggest markup here on this loan, and I want to share really how we're getting to that and how it can vary and really the power of this underwriting engine. This is a snapshot here. This is just one scenario, indirect loan used 60 months. There's almost 300 outcomes or rate outcomes that this application can land in based upon a multitude of characteristics. What you're seeing here is credit score is obviously very important in our underwriting. Depth of your credit file. We have classifications, thick, normal, and thin, have a very big effect on future performance and what that risk profile is. Loan to value is very sensitive to not only the severity of the loss, potentially because it's a higher advance, but also the frequency of default increases lockstep as LTV increases. So we're accounting for all of these risk factors in our underwriting. And just to illustrate that, right, a 640, I can highlight it here, a 640 credit score, 115 or 100% retail advance. This is a clean trade LTV along your top axis. So 640 score, 100% retail advance, that rate can be as low as 10.3 or as high as 12.1. And why is that? Just based upon the depth of the credit file, a borrower with a thick credit file by our classifications, that default probability is around 11%. That same 640 borrower, 100% retail advance, but has a thin credit file, that default probability jumps to 18%. That's a very different cost, very different risk profile. In a garden variety risk-based lending program, they're all charged the same rate. Just to take that illustration a little further, let's say it's that same 640 borrower, thick file, you put some money down, it's an 85% front-end LTV. That default probability is around 4%. Same 640 borrower, thin file, rolls in some negative equity, 125% front-end LTV, which is very common a lot of times in this credit space. That default probability is 24%. That is a quantum leap, 4 to 24. Again, typical program, they're all charged the same. In our program, that default, that insurance cost, that risk margin is very specific to the risk profile of that application. So that insurance cost is going to vary from loan to loan. Just another example of this. You can see different rate outcomes just based upon the characteristics of that application. We mentioned or talked earlier about the stipulations and where they would appear. This is a snapshot of what a lender's protection approval would look like. So this would be basically, it's right within your LOS. You'll get this full detailed approval, all the details of the approval, robust callback sheet. If the borrower wants to buy some additional rate, you can see exactly what the options are, what your maximums are, collateral information, our stipulations again right here, conspicuously displayed, book out sheet, POI. It'll tell you what you can sell in terms of back ends. And this is something that will come with every approval. I talked about our insurance companies. Just talking a little about the cost of the program. The insurance cost is the largest of the two. This is charged as you go. It's a pay-as-you-go program. So if the cost of the insurance is projected at $2,000, for example, over the life of the loan, in month one, you're just going to pay that month's premium, $40, whatever it is. It's always a percentage of the interest payment. And you're billed 1 month in arrears. So borrower makes a payment. Next month, you're billed for that month's premium, and you'll reconcile that each month. It's built into the contract rate, and it's only charged on active loans. Again, it's a pay-as-you-go program. If the loan pays off early, you're going to code it as paid off, and that's going to trigger us to stop charging you any more premium. If it goes into default, you'll file a claim. Typically, lenders will set up a unique loan or product code, some way to identify your insured loans from your uninsured loans in your core and for billing and reconcilement purposes. Really what you're doing here is you're mitigating, you're reserving on the front end through the insurance component. The second cost is our program fee. This is what keeps the lights on at Open Lending. Again, this is a pay-as-you-go. It's only charged once a loan is funded. There's no cost to a lender with this program at all until a loan is actually funded through the program. We have an implementation team that will take you through the entire process. It's typically a 4 to 6 week process, one call per week. From a lender standpoint, it's maybe 10 to 12 resource hours over the whole cycle. Typically, zero IT involvement required because our interface is already built. All training and support going forward. We got a great support staff in Austin, Texas that always gets rave reviews. They're very responsive, knowledgeable. You'll have a dedicated account manager that will work directly with your credit union to make sure you're getting everything out of the program that you're expecting to. All of our decision engine technology, risk-based pricing modeling, all the technology and analytics that go with the program, which are extensive. And also, we've got a whole host of validation reports that are going to be available to you every month. So you're going to have a very good idea of what's going on in your insured loan portfolio every single month. And I'm going to share a summary report here in a second. But the visibility on the program is a big part of our lenders' success. Today, I think the last time I was updated, over 98% of our customer base achieves or exceeds the target yield that we've modeled with them in our pricing tool. And much of that has to do with the visibility on the program. This is an example of how the costs are paid. I spoke to this, but I want to share this illustration with you. So typical loan schedule, say the insurance premium is projected at $929 and change over the life. Month one, your bill's $35 and change, just that 1 month, that current month's premium. Next month, it's going to decline to $634 and change. Always a percentage of the interest payment. It declines lockstep with the balance. Program fee, 3% of the advance, not to exceed $600. You can pay this. Typically, best practice is you treat it like a dealer flat. You pay it up front, treat it as a prepaid expense over some average life. If you choose to pay it in 12 equal installments, you can do that as well. So in this case, you can pay the $390 and again treat it as a prepaid expense, or $32.50 for the first 12 months. If the loan pays off in month 6, for example, you don't owe us the rest of the program fee. However, with that option, there's no cap at $600. So any advance over 20 grand, you can potentially pay a little higher program fee. I guess the point there's a couple options, a couple ways to skin that. So, folks, Christine, in summary, that's our Lenders Protection Program, at least from 35,000 feet. It's a great tool to help manage auto lending, help really expand your auto lending, generate some incremental loans, generate some higher yields, more importantly, but done in a way that's controlled, prudent. You're managing that default risk. You've got a great tool to manage that default risk, and really it's going to help benefit your members, you guys as lenders, your dealers. You can help strengthen relationships with your dealers as well. Again, I really think this is a win-win-win for everybody involved. Getting started is really a piece of cake. We can have you up and running in 4 to 6 weeks. No cost out of pocket, really a program agreement, some due diligence, and we'll start building out your program. I talked a little bit about this implementation. We try to keep it as easy as possible for a lender. 45 days or less, you're up and running. So folks, appreciate your time today. I can get this data out to Christine to share with the group, and please, I look forward to talking with each of you individually, should you have some interest.
Thank you, Steve. Now, does anybody have any questions? No, Steve, I've got one. Do you have a credit union that you think, I'm not saying a name, but like a credit union size or someone that does a lot of indirect lending this program would be good for? What type of credit union is open lending? Who does it fit?
So the program really is scalable across all shapes and sizes, right? So we've got credit unions that do, like Penn Fed, for example, does 1,000 loans a month with us. Then we have other credit unions that do 5 loans a month with us, right? So on varying loan origination platforms. So there's really not a specific credit union that we're looking for, right? It works with all shapes and sizes, basically.
Nice. And now I think that, and I said this in the beginning, that this would be a good program for somebody who is, whose members may not have the best credit, but you're trying to get them to, you're kind of giving them this is how to improve your credit. You're teaching them along the way, and they really don't fit your guidelines for your lending program. And so, this would be a good way to still keep them instead of going with the Santaners, the Chase or Capital One, people of the world, because we really don't want them to go to these banks. We want them to stay with our credit union, and then we want to show them how to get out of this 12% interest rate and go to the 2.99 rate.
You got it. That's exactly right. Puts them in a loan that gives them a chance to succeed, right? So the next time around, maybe you don't need to insure that loan. And they come back to the credit union for loan number 2.
Right. And it's a success story.
Absolutely.
Well, thank you. I really appreciate your time. And if anybody is interested in this, you can let Jeff Kane know, or you can reach out to me. I will make sure I get the documentation out to everyone as well. And we are going on our lunch break, and then we're going to have Doug Rusin at 1 o'clock from CUNA Mutual, who will be talking about credit washing and other fraud areas to keep your eye on. So I appreciate everyone's time. And Steve, I really appreciate you joining us, and have a great day.
A pleasure. Take care.
Bye-bye.